Michael, I was going to say, this is exactly what you said earlier, which is when you're seeing a fundamental, well, actually, no, it's almost the opposite. In this case, where there's a fundamental oracle, which is on the USDO plus USDO, zero, sorry, because they are creating their own market, like they've set up their own specific market, they were able to set a fixed borrow cost and use oracles that mean you won't get liquidated if there's any market variation in the collateral, which is fantastic. The other markets are not so. If there is huge variation, there is a potential chance of liquidation. And I think that's why we're seeing higher APRs, because the higher risk profile for the borrower. And so they need that higher APR in order to be incentivized to jump in there. Welcome to today's episode of the Dojo Pod. Today, we are joined by Michael, co-founder and CEO of Euler Labs, not Euler, for those of you who may have gotten that wrong. I think by this point, most of us know, but just for the fun of it, Michael, can you explain where the name for Euler comes from?
Yep. So it's great branding. We're named after a dead Swiss mathematician from the 18th century, which everyone's expected to know. No, the reason we're named after this Euler character, I don't know why you pronounce it the way you do. Apparently, that's just the Swiss pronunciation for this spelling. But essentially, Euler was a very famous mathematician. One of the things that he studied, amongst lots of famous results he found, was he developed or extended the formula for compound interest. And when we first launched Euler, you had compound already existed, which I think is a fantastic name, fantastic branding. And we thought, well, what happens effectively when you compound interest rather than compounding it over, a year or a week or a day? If you really want to maximize your compound interest, then you do it instantaneously, like as the smallest unit of time you possibly can. When you do that, you get to this magical number called Euler's number, or E. And so we chose Euler as the name for our project, based on maximizing your compound interest.
We just rediscovered the equation for APR to APY recently, and it uses Euler's number. Yeah. It's like, oh man, I'm going to get it wrong. It's like E to the 1 minus AP. No, AP. I'm going to get it wrong. Do you know what it is?
Yeah, I think it's E to the APR, right? -1, probably, something like that.
E to the APR -1, yes, but not APR in parentheses -1, which is what I thought it was before. The other one, which I do use more frequently, is APY to APR, which is the
log
of 1 plus APY.
Yes, that's right. Yeah, very good. Yeah, exactly. Yeah, so that's a little bit of lore for you. It's kind of like a fun story, but it is makes it hard for people to pronounce our brand, and it makes it hard for us because we either end up correcting people like awkwardly, or like sort of like passively aggressively saying it differently to the questions you get, or you just revert to saying Euler and sort of going along with the crowd, but then you look like you don't know the origin story if you own brand, which kind of looks silly. So exactly. There you go.
Yeah. That's like when people call me Stefan. What do I do? I mean, I said, well, no, it's Stephen, or just say, my own name in the call, and it feels weird. It feels awkward. You just have an entire protocol built off of that. Oh, well, do you know how to say his? I don't know how to say his first name. It's like Lionheart, but Swiss, so Leonard.
Oh, it's Leonard, I believe.
See?
I believe.
So I was only pronouncing half of it right this whole time.
Yeah.
Leonard, that's so much easier. Okay. Oh, man, Lionheart sounded cooler, though.
It does sound pretty neat, yeah.
If I was him, I want to change to that. Let's talk about Euler. So Euler is, for those of you guys who don't know, like probably the fastest growing money market. Money market is just another name for borrowing and lending and borrowing protocol in EVM world. You guys skyrocketed from virtually nothing in September of 2024 to now. This is, I think, net. If you look at like the gross TVL, I think it's over $1 billion. Do you know how is DeFi Llama looking at TVL, and then how are you guys looking at TVL, and where are you now? I mean, either way, it's meteoric, but I think there's two different ways to measure TVL.
Yeah, so if you look on the top right there, you'll see it. There's a mechanism to include borrows, and it depends. There you go. So yeah, and then it still says on the top left there, total value locked now, nearly 1.2 billion. So there's good reasons to use both different measures. So TVL, the old way, the way you just had, the smaller number just represents the value that's actually still in the protocol. Now, for most protocols, like DEXs, for example, that makes perfect sense. It's literally how many deposits do you have? However, for lending and borrowing protocols, it's a little bit weird because the total deposits then get reduced when people borrow because the funds leave the protocol. And so the question is, should you include those borrows that have been taken out or not? And yeah, I don't think there's an easy answer. I mean, they both measure two different things.
If there should be like an NAV versus TVL, TVL being the total value locked, the collateral is locked in there, and NAV is the net asset value, which is total collateral net of total borrow.
I quite agree. We have this tendency in DeFi and crypto generally to sort of rename things and give them strange names. So like NAV is a very widely used metric in the rest of the world. So I quite agree. One thing about the NAV is that it can sometimes measure almost capital inefficiency, because you can have, if there's no borrowing from the protocol, but there's quite a few deposits, maybe a protocol has, let's say, acquired some private deal to boost its deposits, but there's no real demand to borrow that liquidity, then I think it can be measuring the inefficiency of the protocol. You see this a lot, like the NAV changes a lot based on borrowing. So I prefer total deposits, but some people dislike total deposits because an easy way to juice total deposits is what you've seen some protocols do in the past.
LTV, max leveraging.
Yeah, you can, or even like self-collateralizing. So you could like deposit, USDC and borrow USDC. You're not really doing well. Sometimes actually that's a legitimate trade. I should stop myself there, but
it's the next part, which is the Curator model, because you could borrow, for example, USDC from Curator B, collateralize USDC from Curator A, and that could be a net positive trade. Now, actually, I want to get Mara's opinion on this, because he has been in the trenches of I'd say every money market since the dawn of time. He's actually multi-hundred years old. Mara, you've seen the rise of curation. What is your take on the Curator versus like the monolithic borrowing lending protocol?
You just cut out there for me for a second. I'm not sure if that was my...
It was bad internet. It's my bad. I said, what is your take on the Curator model versus the monolithic borrow lend?
Yeah, I think it's a great question. I mean, certainly something we should get into with Michael. I guess my opinion is that like they both kind of have their uses, right? Like I think, an easy example of this is something like Bitcoin, which is an asset that like most people want, to lend out. And until recently, there was not a lot people could actually do in terms of like different strategies around Bitcoin, other than just like lend it out and borrow other stuff against it. The classic, like, strategy for a lot of people that wanted to get yield on their Bitcoin was to collateralize BTC, borrow ETH, convert that into some LRT, for example, and then like loop that up. And so having the ability to get, kind of multiple types of collateral in there, multiple types of debt, even sometimes, I think is a great part of like the monolithic strategy and can open up, different pieces. But we're now in a world where like people are really focused on stablecoins. People are really focused on derivatives. We now have Bitcoin, I guess they're called LSTs, soon to be maybe LRTs, if, Babylon kind of comes to fruition. And so that means we need high leverage on like the like pairs. And I think, on this kind of more curated model where we have different types of risks and you don't have to just like generalize that across all the different, broad market, it's pretty appealing, right? Like it's pretty appealing when someone says, I'm willing to take on the risk of Lombard. I'm willing to take on the risk of Kelp or whatever it is, or stablecoin, for example. And then, because they're in a bit of a walled garden, the LTVs can go up and the strategies can get, especially interesting. So anyway, maybe we should just push that thought to Michael. I mean, he probably has a lot more well thought out idea on it, but as my experience as a user, I do think that there is a little bit of apples to oranges, and they are really kind of different primitives that can be used for different strategies and use cases in DeFi.
Well, it's an interesting question for you, Michael, because I think you once said that, sure, Euler, you could build Morpho on Euler. You could also build Aave on Euler. You can build all of these major borrowing lending protocols using Euler as sort of a primitive. So can you sort of explain why Euler went the direction that it did? Because I remember back in the day using Euler V1, and it was sort of like a monolithic protocol. Now you guys have gone the Curator or like the bespoke money market choose your own adventure route. What was the thinking behind that?
Yeah, so V1 was very popular, and it was, I guess it had most of its success in a time when there weren't all these different assets. But even back then, I could already tell that one of its shortcomings was that just people have very different risk reward appetites. Some people seek out conservative yield. They want to just lend their assets and kind of walk away and come back in a year and maybe even 3-4%, and that would be, a great result for them. Other people want to take more risk and access some of the more exotic yield bearing opportunities out there. And monoliths don't really give you the scope to create those opportunities for the different types of user bases. To do that, you need to isolate risks and to create bespoke risk reward opportunities for people using different assets in different places. So you need a way to kind of replicate markets and parameterize them differently to accommodate different needs. And the monolithic model doesn't really cater to that very well, because the monolith is kind of purpose built to just be like one marketplace where you go, and if you like the setup, then use it. If you don't, then there's nothing else for you, really. That was always like how Aave worked. And in the absence of the curated model, all these different like bespoke money markets, something like an Aave did very, very well for many years in DeFi, but that's partly because it was an immature DeFi environment, I think, without so many assets and without different types of users. Haven't historically been that many users of money markets. Now we have that, though. I think it's great to give people the opportunity and freedom of choice, right? And there's no free lunch. You guys talk about this a lot, but there's no free lunch ever with any model. The risk and reward are two ends of, in opposition always. And so, yeah, it's not necessarily that monoliths are worse or better. It really depends on the users and their needs. So when we were building Euler, we built with this philosophy that you should be able to create bespoke markets for different use cases. And that's ultimately what you can do with it. As you said, you can create something that is effectively functionally equivalent to Morpho on Euler, or you can create something that's functionally equivalent to Aave, or anything in between. And I think we're the only protocol that offers that flexibility for the builders and developers and risk curators. And that's really because we make the individual vault the primitive unit in Euler, whereas I think in other protocols, the primitive unit is the kind of market, which would be, for Morpho, the simplest possible market you can have is, one collateral and one asset that's being borrowed. And that's the simplest possible market. And on Euler, you would create that very simple market by just having two vaults, right? Linking them together. But you can extend that model, on Silo, as you guys probably use Silo as well. On Silo, you can use A to borrow B and B to borrow A, and then you can create sort of little chains between these pairs, and you can do that on Euler as well. So you can create little mini silos. Another model is the compound one, where you have a single borrowable asset and you have multiple collaterals all feeding into that single borrowable asset. You can do that on Euler with the vaults, So yeah, we can replicate any design on Euler, and you see versions of all those different kinds, I would say, on Euler today already. It's really down to the risk curators.
So my next question is, you can do a ton of things on Euler. Like I said, it's effectively a choose your own adventure, but what are people doing? So I saw a recent tweet from Morpho saying that something like, maybe I'm over exaggerating the number, but it was something like 60%, maybe it was 30%, which is a big difference, but it was a meaningful percentage of their total TVL was now pendled primitives, which I thought was mind-blowing. Like I knew it was going to be a lot, but I wasn't expecting that much. What are people doing on Euler? Where are you guys seeing most of the TVL growth?
It's actually quite varied, I would say, on Euler, probably reflecting the different, design of the protocol. Just recently, for instance, we're back to kind of LST and LRT looping. And actually, as you're scrolling through the strategies page here, I noticed that actually there's some of the highest yielding opportunities on there, and that probably reflects the changing risk environment. As you say, there are a lot of different varied markets, and so as the risk environment shifts, we tend to see quite big changes in the composition of different types of lending and borrowing on Euler. In the early days when we first launched, one of the risk curators, Apostro, brought on board this Resolve market. Resolve was a very big market on Euler for the time being. That's sort of the growth there has slowed off a little bit more recently. Yeah, we've seen Bitcoin LRTs, and looping those was popular for a time, but it's probably gone off the boil a little bit now. We're back to LRTs. There's been a lot of stablecoin related activity with Usual and with Athena based assets. So there's a little bit of everything. I mean, there's Pendle tokens, although I can see that they're not really showing. There's not too much showing on the strategies at the moment with those. But yeah, I will. I mean, yeah, there you go. Yeah, I mean, there's a little bit of everything, and it really does shift quite a lot, I would say. It's quite dynamic. We have quite a lot of users on Euler, which is nice to see. One of the KPIs people look to is just TVL growth, and that's obviously it's nice to see extra usage reflecting that number, but we also see quite a lot of just actual user numbers going up, and we have much bigger numbers, for instance, than even some of the kind of the older money markets like Compound. Euler surpassed them quite a while ago in terms of user numbers, and I think that's just because there's lots of different types of things to do, and the composition changes by network as well. On some networks, there's very different types of opportunities, and there's a bit of everything.
So we can talk about that too. I have been using leverage PTs for a while, and I say live by them, die by them, because they can be amazing if you have the right oracles and if you have a deep market. But the thing that's hurt a lot of people is in a bull market, they're more dangerous, because in a bull market, the IY, the implied underlying yield, can increase, which means the PT value can decrease, which can liquidate you, even though you may have thought you were like in a sort of stablecoin yield. During a bear market, they're fantastic, because very recently the IYs went down, so all my leverage PT positions like increased by a leverage relationship to that. Decreased IY, increased PT value. So that's pretty amazing. These have, as a new sort of Lego block to play with, they've been phenomenal and fantastic. And $10 million to borrow against them here, $8 million to borrow against here. This is 26th of June, so 2 months more worth of yield here, actually 2 months and 2.5 months. Here, EUSD, another month and a half. And, you see longer expires. I'm glad you guys went with the numbers and the month. Contango, whom I love, they went with like the Chicago market style notation, which I had to learn, and it was like a whole new language. But you guys are on other places. So Sonic and Avalanche are the two that, well, actually Sonic, all of these really.
Yeah.
We were looking at Bob yields the other day because they had an incentive campaign with OP. There's also Bear Chain with a number of things we'll look at in a second here, but Sonic is first because they have one of the positions that I'm personally in that I've liked for a long time, but they have all these interesting stablecoin plays. So by the way, if you guys don't know, you can literally just sort by stablecoin. So USD for your collateral asset, USD for your debt asset, and there you go. They auto-populate. If you want a more detailed look at all this stuff, I just click borrow. I will say, for me, like I use borrow more than strategies, but if I want to do a strategy, I'll just click in it and then it opens up the same page, which I love.
Yeah.
So here, USD, and you can, look at that, $6 million liquidity. It's crazy. As a reminder, if you are on Sonic, you're getting points. So like USDCE, I think is 10 points per day per dollar. SCUSD is 12 points per day per dollar, if I remember correctly. And then PT, you're giving up the points. No points for you. Did you guys do anything with gems?
So, good question. I'm not the gem master, Euler. I think I'd have to check with Lee, who's on our team, who's been handling this. I think we are registering for gems, but I don't want to say too much because I'll probably get it wrong in terms of how they're being allocated. How we've set it up. But I think we're doing something there.
There's a possibility. Okay.
Yeah.
Well, I just had one quick question, which is, Steven's been outlining, the amazing plethora of chains that you guys are on, and feels like if there's, a hot incentive program or a hot ecosystem, maybe a better way of putting it, you guys are there, or, which is fantastic. Quite different than other money markets that seem to, take quite a bit of time to like move over and like decide they want to go. I'm sure part of that is just that, you guys are in a heavy growth phase and you guys are like looking for all these opportunities. But I am just curious, like how you guys assess and kind of like think through, whether it makes sense to launch on one chain or the other. And like, what's the broad strategy here? Is it to be, everywhere? Or, is it kind of, this is just a period of like high growth, you want to see where the different markets are, and then in the future we might see, other sorts of changes?
Yeah, ultimately we build the app for users, and I spend most of my time on Ethereum mainly, but I recognize that there are all sorts of different advantages to other chains. If you the first time you use Sonnet, for instance, it's just insane. If you've been used to Ethereum, it just feels like totally different because it's just so fast. And there are unique advantages to all these chains, and then they're all trying to carve out for themselves, I'd say, a position with the market where they have, where they occupy a niche. And I think that's ultimately where the multi-chain future will be. I don't think there's a single chain for everybody. I think it's up to these individual networks to kind of make a home for themselves where people go to do certain types of things. There might be, one chain that's more suitable for certain types of trades than others. There might be one that's suitable for stable coins or institutions, some that's more suitable for sort of retail-based trading, and so on. So I think, it's important as a developer of an app to meet the users where they are. And so we've typically tried to follow user trends. So yeah, I mean, I expect that we will be going to more chains. You can see BNB just in beta down at the bottom there. That's an upcoming launch that'll be happening very, very shortly. But there are lots of other networks that I suppose Euler will be on as well. It really depends where the users. If you're a network that can showcase that you've got real users, then Euler wants to be there so that we can provide lending, borrowing functionality for your users ultimately. So that's mainly how we target things. Sometimes it's, you have some of these networks have a big push on their own growth, and so it's good there's a nice synergy there where Euler can come and we can kind of help the network grow, they can help us grow, vice versa. So yeah, I think it's important to be dynamic, but the way that Euler's built lends itself to being deployed, relatively easily. Like I said, with something like Euler v1 or a monolithic protocol, it's very much built in a specific way for a specific kind of user base, whereas Euler v2 was built through these modular principles, and so no matter what kind of setup you have on a particular network, there's always something you can deploy on Euler that makes sense for that network, whether it's more isolated markets or more monolithic type markets that's more curator based or more sort of DAO sort of centrally managed. There's always something you can build, and so it enables us, enables the project to grow a little bit faster in that regard, and we've been able to move to new networks relatively quickly.
So I have a follow-up on this. You said you go where the users go. And that sounds interesting, but I'd like to give you a little bit more credit because from my experience, you guys have gone somewhere, had remarkably attractive yields, and then drew users to you. So I would say this was true for Sonic. I would say this is true for Barachain. I think the only people that I've known that have ever used Bob went over there because of the incentives on Euler. I mean, 21% on LBTC against Rep Bitcoin, organic borrow line. And then that's been the case for over a month now, maybe 2 months of 21% on Bitcoin. And then now recently, the only reason, and no shade to AVAX, actually, I love the Avalanche chain. It was the very first L2 that I ever used. And it was like a mind-blowing moment the very first time I went over to a chain that wasn't ETH. And I was like, you can do what for how much? So, I have a very high level of fondness for AVAX. You guys brought attention back to them. So I would say that maybe you guys do go where people are going. I think I saw you guys go on to Base. We're seeing you guys go on BNB. But on the flip side of that, it seems like you're bringing the attention. So can you tell me about what is going on over at Avalanche and how you guys are maintaining these like over 50% APRs on stablecoins?
Yeah, I mean, I've got to give credit to our risk curators here. Honestly, like one of the nice things about the product that we've built now is when you see other people building on top of it, stuff that you yourself might not have built, or that you have no real, so sometimes I get caught out because someone asks me a specific question about a market that's been built or a specific asset. And I have to give credit to the risk curators because they often are the ones at the forefront of things, leading the way, and they understand their user base and their markets and so on. So yeah, I mean, shout out to RE7 here that on the page right now, because they're, I think, got a fantastic market over on Avalanche right now. Incredible growth within days. I think over 100 million. And as you can see, there's incredible yields here, which is, probably why people have been attracted. I think what Euler does is we try to provide the infrastructure and try to do a really good job on the infrastructure side so that the risk curators can flourish and help provide really great markets for people. So we work quite closely with them on the back end side of things to make sure that everything's displaying well, that you can do these one-click actions quite easily, like you can open and close positions, because there's a lot of work goes into this. There's a lot of composition happening in the background between Euler and other dexes and aggregators and all the rest of it. So yeah, that's where I really see our job is to make this that you're kind of browsing through now all work really, really well. And that's been that's been not easy, to tell the truth. The first few months were really, really tough trying to build such a kind of complex product, I suppose for all sorts of different types of users. There are all sorts of challenges there, but like great example. But yeah, there's just been incredible growth over on Avalanche, partly because of the success that risk curators have had in curating like great markets over there.
So would you say then that the majority of the growth to exotic assets and growth new ecosystems has been curator driven, or is it a mixed bag of you guys know you want to go somewhere, they know they want to go somewhere, and it's a conversation?
It's always a little bit of a conversation, I would say. Yeah, we don't have a massive like business development team or Euler Labs. We're very engineer heavy, I would say, as a team. So there's just a couple of people that would typically do business development, and they work exceptionally hard. So they have great relationships with all of these risk curators. We also have great relationships with a lot of the product teams and the asset listers, and of course the networks themselves. And so sometimes it's a case that we help bring people together, and sometimes it's a case that we just take direction from people. They tell us, look, these are great assets. They're over on this network. We'd like to build markets. Can you enable it for us? And so we do the evaluation, we put the work in, and then we launch. So it really does depend on the network and the opportunity, and on what resources we have available at any one time.
So we've sort of been looking at Euler with what I would say, like, maybe not rosy colored glasses, but like sort of singing its praises, right? Over 1 billion TVL, phenomenal.
Yeah.
Some of the best yields on Sonic, Barachain, Bob, AVAX, right? Also phenomenal. But I want to talk about some of the risks that we see with money markets and leveraging and looping in general. And I think one of the main ones is oracles. Me, myself, I think everyone knows if they've been watching me long enough, I got liquidated 2 times this cycle, 2 times. Both on like-to-like pairs. So I wasn't doing anything crazy. And both times it was wrap stakeful. No, it was easy ETH against ETH on Sturdy, and then wrap staked ETH against ETH, which I thought, surely this will be safe, on Gearbox during the unwinding of the yen trade. And everything tanked 15% in a second. Market rate oracles got burnt. After that, we've gone on a tirade to let everyone and their brother know about oracles, the risks, NAV and fundamental versus hard-coded versus market rate. How does Euler tackle the question or problem of oracles?
Yeah, great question. I mean, like with anything, there's no free lunch, I would say, when it comes to oracles. So there are different designs, and we recognize that different designs make sense in different contexts, honestly. There's some people have very strong opinions. If you go on Twitter, you'll see some people are adamant that the market pricing is the only correct way to do oracles. But I don't actually think that's true personally. I think there's, fundamental oracles, or where you kind of hard code a price. I think what that does ultimately is it shifts risks to the lenders. There's no doubt that that's true. But shifting risk to somebody isn't necessarily a bad thing, as long as they then compensate for that risk. So in my opinion, if you take any two market and you have one with, market based and one with fundamental, you should see different interest rates on those markets based on the, for lenders and borrowers, based on the way that they allocate risk to the different parties. And so ultimately the market itself should be kind of pricing in that risk. In terms of the technology and how we handle this on Euler allows you to create your own oracles and kind of package them up and combine them in different ways. So what you saw, I guess, on the market there was sometimes people use market rate oracles, and they will effectively, if you want to price, let's say let's say you had a WETH price to USD, and then you had a USD price to BTC, and you wanted to price the WETH BTC pair, then you could kind of combine 2 oracles together to get that pricing. Now, so you have these sort of cross oracles. You can alternatively, hard code the oracle, have a fundamental oracle, use secondary market pricing. We support Chainlink, we support Pith, we support Redstone, Chronicle, and various other providers as well. Essentially, under the hood, what's happening is we have like an adapter system that has a kind of standard interface. And that standard interface allows us to kind of wrap up any other Oracle providers and kind of push them to our UI. And then it's up to the risk curators what kind of pricing system they want to bring to a market. And then it's ultimately up to the users whether they like that risk pricing system or not. If you maybe click on one of the links in one of the oracles, it should take you to a dedicated page we have for oracles, where if you really want to get into the weeds of things, you can actually come here. And this is probably not, user friendly, but it's super important information. If you really, really want to do your homework on an oracle, you can see this is the underlying data about how a specific pricing pair works. So you can see we've got the methodology, we've got the operating model. Is it pull or push oracle? Like if it's, Pith, they have like certain parameters like max staleness, max uncertainty. So all the information is here on a dedicated website, oracles.finance, and that's really for the Oracle nerds or the people who really want to get into the weeds of things. But for everybody else, I think the main consideration is, is it market based or is it hard coded? And I'm not here to settle that debate. I personally, I think there's no perfect solution, and oftentimes hard coding can make sense and actually kind of it maybe increase the stability of the overall system. even if it's vulnerable to its own issues and so when prices move against you.
Well, yeah, I think one of the first money markets, interestingly, that we saw do a big push to a hard code oracle or an NAV oracle was Aave. And then once they did, everyone was like, okay, so there's something here. Like there's some credence to actually doing this. And then the idea of NAV came out. Well, I mean, it's been around for a lot longer than DeFi has been around, but there is some underlying value here. There is also the ability to redeem, and since there's an ability to redeem, because there's underlying value here, if you trust in the robustness of that underlying value, then there's no reason not to use an NAV oracle. I mean, again, like you give this risk to the curators, and that makes a lot of sense. If there's no redeemability, and this has been the biggest risk for DeFi, then maybe you don't want to do an NAV oracle because the NAV can't be realized. There's no ability to arbitrage to NAV with the lack of redeemability. Anywho, I have greatly enjoyed the fact that we can look at the oracles. One of my biggest gripes was that a lot of money markets previously had obfuscated where the oracles were, what they were, how they were, and I think enough people were like me this cycle, got a little bit burnt, and now oracles have become part of the front end, and I love this. This is huge, being able to look at the oracle in real time. So here, just looking at it, USDO to USD, it's a market rate oracle. Okay, well, how are you pricing the debt? Well, it's SUSDS to USDS. This is an NAV oracle, so it's exchange rate, even it says so in a little description there. Exchange rate of how much USDS is backing SUSDS, and then it prices the USDS in USD and market rate. So you can look right at what's happening with your oracles, know exactly what your risk is, and to me, that's really comforting. Even if it is a market rate oracle, at least I know, and I'm not going to be surprised something happens. So we were looking at USD 0 plus. I think that's the way to say it. I really have no idea. Usual USD, I think, is what Mara usually tells me when I start giving the big name. And there are some really kind of wild yields here. But my first thought was, well, these oracles aren't the same. And Mara, you in the dojo actually gave a really good description of how you should think about this play. If you want to talk about it, I would love to hear your verbal, the way in which you're looking at this.
Yeah, absolutely. Well, this is actually a pretty interesting and kind of unique market to Euler in that there is this like stability loan market here that has been created. It's the top one on that list right there. And it is basically the zero coupon bond that Usual is providing. I think it's like a 4-year loan essentially where you are, giving up your liquidity. Is being put into treasury bills or kind of other RWA type vehicles. And, it's kind of similar to like a Frax bond, but this is like the Usual version of it. Anyway, it's not really aiming to be a stablecoin. It's not aiming to be something that's pegged 1-to-1 to $1. And instead, it's this asset that is paying yield over the next 4 years and then currently being heavily subsidized in Usual tokens, which is what makes it kind of especially interesting play right now. So you can borrow the stablecoin version of this, which is USD 0, against the 4-year kind of almost like a zero coupon bond version of it at a fixed rate of 5%, which is fantastic because, they are paying out a lot of Usual tokens. Now, some people are in this. Some people are having fantastic time. As you can see, it says max ROE, which is, expected return is like almost 60%. However, there are some things you need to be careful with this. Like one, first of all, is that like USD 0 plus is not a stable coin. As we just said, it's a kind of like almost like a zero coupon bond. It should be discounted, against kind of like the illiquidity that you have over like the next 4 years and not being able to get out of it, with redemption, but you can swap out of it. And because it's a swap, the market is pricing this at different rates. They obviously had a bit of like a tumultuous period. It looks like, when was that? Kind of beginning of the year at some point where it went from being valued pretty much by the market as $1 down to 90 cents roughly. Since then, it's been kind of coming back, and that's largely a thing due to all the incentives that, they are providing. And so, people have priced it from 90 cents now all the way up to like 96 cents. So yeah, fantastic play. I think it's like a very good kind of example of something that Euler can do that other money markets can't, with the type of oracles that are being used, with the kind of, like segregation of risk that's being put onto this. Like if you feel like taking on the risk of interaction with Usual protocol, you can come and do that. And you don't have to be worried if you're a different user of Euler of like the risk cross-contaminating something else, like which, you might see on a Compound or an Aave or something like that. So I think it's really fantastic. I do think it's like, like this is more like, not really a stablecoin play as much as almost like trading, right? Like what is the real value of USD 0++? You kind of have to go and decide that for yourselves. You can say that it's been appreciating in value from 90 cents to 96 cents. Maybe that means it's less risky now, but also, we could see a mean reversion back down to those low levels because of this kind of nature of the asset where, you can't redeem, for a set period of time. And so the market's pricing it higher because of the high yield. But in the future, the market could price it differently if, for example, the usual token goes down in value or they decrease the emissions or many different factors that happen. But yeah, I think it's an excellent example of just like the interesting unlock that something like Euler provides, for the brave who want to go out there and kind of like do their own research and think through all the different kind of scenarios of what could happen with these different usual assets. There's certainly a lot of interesting meat on the bone when it comes to, almost 60%. I don't think we call it stablecoin yield, but like RWA yield out there for people that want to go get it.
Well, and this Michael was going to say, this is exactly what you said earlier, which is when you're seeing a fundamental, well, actually, no, it's almost the opposite. In this case, where there's a fundamental oracle, which is on the USDO++ USDO, because they are creating their own market, like they've set up their own specific market, they were able to set a fixed borrow cost and use oracles that mean you won't get liquidated if there's any market variation in the collateral, which is fantastic. The other markets are not so. If there is huge variation, there is potential chance of liquidation. And I think that's why we're seeing higher APRs, because the higher risk profile for the borrower. And so they need that higher APR in order to be incentivized to jump in there. And I see this is what you were saying, I think, earlier on.
Yeah, the interesting thing about this is the underneath the UI here, the usual team themselves built kind of took advantage of some of the unique features of the underlying technology on the vaults that are only possible on Euler, really, to kind of hook this market. That we know Euler vaults have these things called hooks, which are sort of similar to the Uniswap V4 type hooks that probably more people will be familiar with. Essentially allow you to build in custom functionality. And so, yeah, this is probably the most bespoke market. We've got a few others that are kind of interesting, like the one by Idle and Fastenar is kind of unique as well. But this is definitely one of the ones with where someone's taken advantage of the most advanced features on Euler to kind of create something completely unique. And as you say, it's got this fixed borrow APY. The USD 0 here is not supplied, on the borrowing side, is not supplied by individual lenders in this market actually, but is kind of a direct deposit module connected to usual. And that's not true on most markets, right? The USDC market is just a permissionless market. Anybody can lend and influence the amount of liquidity in that market at any time. But here, it's in the usual stability loan, it's a direct deposit, similar to some of the stuff we've seen with Maker. And so, yeah, very, very cool market to see. Yeah, as you see, you've highlighted plenty of the risks as well associated with this, but from a builder's perspective, we're just extremely happy to see people creating unique stuff like this on Euler.
Well, that kind of leads to, I think, my final question, which is, we've seen what can be built. When Euler first started V2, I thought they're going to fragment their liquidity. Like, how are they ever going to build up? Like, we were seeing success with Aave because they have this monolithic pool of borrow. We're seeing some success with Compound as well for the same reason.
Yeah.
And then, well, as if you guys predicted the future, the Curator narrative just took off in force. We saw RE7, we saw Stakehouse, we saw MEV Capital, we saw Apostra, we saw Tulipa. We saw all of these curators come in and sort of bring their hedge fund funds onto the lens side and just create the markets that everyone wanted. So one, phenomenal foresight, and I was blown away by that success. Now you have protocols making their own markets. So like usual that you just mentioned, what is the next step? What's the future of Euler?
Well, we've got quite a few extra things that we've been building that we, would like to introduce to the market that will help further increase the efficiency of these markets, I think, and help increase yields in some cases. One is an extra layer of that's custom built for passive lenders. We're calling it Euler Earn. And the Euler Earn is a kind of vault where lenders can deposit USDC, and then an asset manager who's a risk curator or otherwise some kind of governor will then deploy those USDC assets, for example, into some of these, as you said, somewhat fragmented, like lower level markets. And they will then be the ones, the asset manager will then kind of control the risk and reward that's taken on by the lenders. What this does for lenders is it provides a more efficient kind of passive lending experience. At the moment, if you're a lender on Euler, just a pure lender, you don't want to do any of this borrowing activity, you might have to move your lending positions around over time or keep an eye on them as the risk environment shifts. Whereas with using an asset management vault, it would be somebody else's job to do that for you, to constantly provide you the best risk-adjusted yield. So it's a similar kind of setup to what we've seen on Morpho. On Morpho, it used to be called Metamorpho, was this layer of asset managers. Euler will be kind of similar to that, apart from, I would say, Metamorpho is a direct feed into the underlying Morpho blue markets, whereas the Euler one will actually, for better or worse on our side, it will actually let you deploy into any yield-bearing opportunity elsewhere in DeFi as part of your allocation, your portfolio. So the asset manager could, for instance, decide to deploy 20% to a cash position, 60% to Euler vaults, and the rest to MakerDAO, or the rest to Morpho even. And so, yeah, it's a more free market, less protectionist model of asset management. It's Euler. The next thing that we're building, I'm excited to, bring to market. I've sort of teased this for probably 2 years now, but it's finally ready, I think, to be unleashed on the world, which is a DEX, Euler swap DEX that we've been building for quite a while, that works extremely closely with the lending market. In fact, it allows any user on Euler to turn their own account into a kind of AMM and allow people to swap on top of their account. And in doing so, the increased swap volumes that come through Euler will then lead to more borrowing on the platform, and that increased borrowing will drive rates higher, which will in turn encourage more supply. And so I think we're hopeful that this Euler swap model will lead to just better efficiency and more liquidity inside of the main markets in Euler.
So this sounds like you guys are doing two new verticals. One of them is a sort of vault curation vertical, which is, here's a vault, there's some asset manager, maybe it's MEV, maybe it's Stakehouse, maybe it's RE7. We've seen them actually do like on-chain hedge funds with Midas before. So like having them do it on Euler makes sense, right? Actually, there's a few other places where we've seen similar-ish things, but you're saying you're going to be able to deposit your assets, maybe stablecoins, maybe ETH, maybe BTC type assets into a vault. That vault will then be custodied by, I imagine the vault will be held by the smart contracts of Euler. Then the curator will determine what to do with those assets in order to optimize the yield of those assets. Is that the basic idea?
Yep, that's pretty much right. I would say the risk-adjusted yield, right? Sometimes they won't be seeking the highest yield, but the best risk-adjusted yield. But pretty much it. And I'd say from the perspective of the underlying markets, what this will allow in terms of efficiency is more like rapid allocation of capital to where it's most needed. Sometimes I would say when a new market springs up on Euler, that there is plenty of demand from borrowers to borrow USDC, but there's no USDC in the market, initially. So you have a bit of a chicken and egg problem. And what I like about the asset management type lending experience is that the curator here can actually identify that need ahead of time. It's their job to do this, and they can go, well, actually, let's move 20% of the vault's funds into this brand new market, and we'll be the first to capture that market immediately. So it allows a much higher level of efficiency, I would say, both for the underlying vaults and for passive lenders.
Well, a lot of people don't know this, but you're sitting amongst fame here. Mara was one of the first people, I'd say, to ideate a lending optimizer in DeFi. In fact, there was one built after his idea. It won a hackathon. Oh no, I'm reconnecting. I lost my internet. Hopefully you guys can hear me.
I can hear you.
Okay, cool. And it was used. And the idea was like it would look at all the different markets that needed lending to. And then after doing a million iterations or whatever in a few seconds, it would determine how much could be deposited to maximize the APR for the user and then rebalance every so often. And it was phenomenal. And now we're seeing a lot of different places sort of come back to this. Mara, sorry, you've unmuted, so I assume you want to speak for yourself.
Yeah, no, I mean, it sounds, I was just going to actually talk about like what it sounds like Euler is moving towards. And it sounds super interesting. And I actually really appreciate kind of tying back into what Steven was just saying, the ability for users to decide what they're allocating to. one of my kind of biggest critiques, I think, of like Morpho has had amazing success, but of the earned products is that it's really hard for the users themselves to understand or underwrite really what they're exposed to. Like they can go in, they can look, they can see which, market it is, they can kind of see what assets are, but like things change so rapidly, and like your average user is not paying as close attention to this as like a curator. So, I think curators are good, but you are signing a lot of trust into them when you deposit into one of those products. And so having the optionality and be able to choose for yourselves, similar to like kind of what Steven's saying, I've been very interested in like lending and kind of optimizing these things out. It is refreshing and is, a decision that, people can make. And some people will want to just go with the curator route. They'll want someone else to make the decision for them. But other people, probably the more advanced users, will want to kind of like do the thinking, do the underwriting for themselves. So that's fantastic. I'm also super excited to hear about more about the DEX, when you guys are ready for that. It sounds like, this move of some money markets starting to incorporate swapping is super fascinating, and like being able to actually have real organic yield on top of collateral, in addition to what people are paying just to borrow it, obviously, like in kind of your monolithic systems. I think that's super interesting. And when that can be tied into kind of like some of these markets that are siloed out, and then, then you go from having no yield on the collateral to at least having some yield. Super fascinating. So
Is it going to be like a fluid model?
Yeah, good question. There are some principles that are shared between this model and fluid, but I would say overall it's quite different. Yeah, in the way that the Euler is essentially, Euler swap enables what we call just-in-time liquidity provision. And the way it enables that is through accessing the liquidity in the lending market. So borrowing the liquidity just in time to supply it to swappers. And yeah, just a couple of just pointers about why I think it could be, a bit of a game changer for Euler is if you have a professional market maker that's running one of these swap accounts with $1 million of margin collateral, they can actually service swaps in ideal conditions. They can service a swap market, which if you were to build it on Uniswap or Curve or somewhere else would actually require $40 million worth of deposited liquidity. So Euler swap will be instantly liquid in some sense because it requires a very modest amount of initial liquidity before you can create extremely deep liquid markets. And the other cool thing about it is that because Euler is, fairly uniquely cross-collateralized, we have stablecoin markets or markets like Euler Prime where there's a lot of cross-collateralized pairs. A single USDC vault inside one of those markets, for instance, can actually service swap liquidity across multiple pairs simultaneously. And so where you have on something like, Curve, people will be familiar with famous like Curve 3 pool, you end up with a kind of like a Curve N pool on Euler. Not quite the same, but there's some elements of that where you essentially you're able to rehypothecate on the DEX side as well, so that a single pool of liquidity can service multiple pairs at once. 10 pairs at a time. So yeah, I'm very excited to showcase it. We'll have to see how it performs in the wild. I don't think it's a swap product for retail users. I think it's a swap product for experienced professionals and market makers. But yeah, all will be revealed in the fairly near future, I think.
If it's a swap product for, let's just say, institutions, or I imagine like it'll be plugged into, all of your lending or all of your swapping aggregators. So it may just get routed through and you won't even know it. You won't even know you're using it. But for lenders, will they be the beneficiaries of this new technology in any meaningful way?
I believe so, because a lot of the trades will come through the swap, which will drive up borrow rates on the core lending protocol. So there'll be more demand for borrowing on Euler than there will be on the lending protocol that doesn't have such a swapping function. And that borrowing demand should drive up rates, which will, benefit lenders ultimately. That's the theory. We'll see how it works in practice, of course. But yeah, uniquely borrowing to provide just-in-time liquidity is what a lot of professional market makers actually do already through various means. But essentially this protocol will make that more accessible and bring greater efficiency to the DeFi markets. And there's a few more announcements with it kind of coming as well, including quite a big collaboration announcement that we'll make at some point. But
I'll give you the last minute. If you want to break any news here, if you want to say anything else, remind anyone of any final Euler points, by all means, the floor is yours.
I can't reveal too much today, but we'll have one of our announcements will be coming in a couple of days. I think about one of the people that's we'll be working more closely with in the future. And then there'll be another announcement sometime in the future, which will detail more about how, exactly how Euler Swap will work and who else we've been collaborating with on this, because there's quite a few people involved, and really excited to bring it to market. As you say, it will largely route trace through existing order flow infrastructure on the networks, and so it won't be something that users necessarily have a nice shiny UI to come and play with at launch, but we hope it will be able to pick up quite a lot of volume through markets on Ethereum already, and I'd love to see whether or not it can compete with existing solutions out there. Like, I really hats off to the team at Fluid, because it's they've been having a lot of success, obviously, with their breakthrough product, breaking ground there. I think in a market that's extremely competitive, building a new DEX often requires you to go out and source massive amounts of liquidity and subsidize your growth. And so I applaud them, and all I can hope is that Euler will have similar level of success. But all we told soon enough.
Well, Michael, thank you so much for joining us. Thank you for giving us a little bit of alpha there, for getting us excited about the future of Euler and explaining sort of its history. Guys, if you don't know about Euler, go check it out. It's app.euler.finance. If you don't know how to spell it, it is probably on his shirt, as well as there's a Twitter, or X, I guess you call it now. You guys also have a Discord. Do you guys mostly use Discord or Telegram for the community communications?
Discord. Yeah.
Okay. Good. Like the real ones. And thank you so much for watching. Have a wonderful rest of your day.
Thanks for having me.